I'm sure that was not a natural reaction to insurance and banking, which of course are absolutely essential. Because I did ask our board secretary why I always come last. And he did look at me and he said, well, you're the most important, you see, because banking and insurance, nothing happens without them. So I think it is congratulations to you for staying. But thank you very much. So in the next 20 minutes or so, I'm going to summarize key developments in each of the sectors covered in this area. It's banking, insurance, and insurance intermediaries. I would like to start, however, by addressing one aspect of the theme of this seminar. That is whether, and if so how, the regulation of banking and insurance might change in the wake of the pandemic. It seems to me that the regulatory rules around banking and insurance have been adequate to face the pandemic. Due to sufficient capitalization, banks have been able to lean into the wind and lend to third parties, albeit supported by G20 governments. And tough liquidity requirements put in after the GFC have worked. There are still significant headwinds to face, such as asset inflation, William talked about that, and provisioning, but so far so good. In the UK, the FCA has had some success in championing fair treatment of policyholders in the case of business interruption, without a systemic impact on the insurance sector. And no insurance company has been caught operating outside its zone of comfort. Regulators have also worked cooperatively with bankers and insurers during the crisis, and the temporary postponement of regulatory reporting is an example of this. Unlike in the wake of the 2008 crisis, I therefore doubt that we will see another avalanche of new capital and liquidity regulation. At least I hope not. But during the pandemic, working from home became the norm. More and more customers started using internet or mobile banking. The use of contactless payments grew considerably, and the use of cloud services increased. And I suspect that in some indefinable way, these practices have accelerated what might be broadly called the digitalization of both banking and insurance industry. And that was something that Philip talked about in an extensive way this morning. So it seems to me reasonable to expect regulators to step up their interest and possibly the extent of regulation in this area. And the key phrase is going to be operational resilience. And this applies at the firm, sector, and systemic level. So operational resilience is a term already the subject of major regulatory interest before the pandemic. But by combining increased digitalization with a global crisis, operational resilience becomes even more germane. And key aspects are cross-border outsourcing, business continuity planning, and cybersecurity. And although not in my remit today, regulatory focus on the resilience of payment systems will increase, given technological advances in this area. So for both the banking and insurance industry, digitalization is about commercial survival and cost reduction. But this does beg the question as to what digitalization means for customers. Does it mean poorer service for most and the marginalization of the vulnerable? Or does it mean slicker and better service for all? Society is going to look to financial regulators in the first instance to address failures in this area. So to summarize this section, I do not expect regulators to rehash capital and liquidity rules in the wake of the pandemic. Instead, regulatory interest in operational resilience and anything with an IT aspect will markedly increase. And senior management at licensees, as well as regulators, will want to continue to deepen their expertise in this area. So moving on, I'd like to start with the banking sector and then later discuss insurance and insurance intermediaries. So since COVID emerged, those banks dealing with the bailiwick public have had much asked of them, both in taking appropriate health measures for staff and customers on the one hand, yet still maintaining an essential service on the other. And I think the local banks have done a good job in striking a balance over this difficult period, remaining open at all times. And local banks have also continued to provide support for the local mortgage market. The private banks had a bit of an easier job in that fewer of their customers live locally. Nevertheless, in their case, the transition of working from home took place with relatively few glitches, all of which demonstrates the benefits of business continuity planning and adaptable IT systems. And it may be that enhanced IT investment for private banks over the pandemic will help them compete against digitally perceptive boutiques in the future. That investment may well be commercially useful. Now, still on banking, in March, the Commission issued a consultative paper on Basel III. Now, there are fewer and fewer subsidiary banks in Guernsey, and this is part of a global trend. The Commission is not going to imitate Canute and try to stop this shift away from subsidiaries. On the other hand, the Commission recognizes that subsidiaries, banks, remain a viable option. And therefore, we will continue to ensure that Guernsey banking regulations are in line with international standards, hence this paper. And Philippa talked earlier about the UK issue of suddenly being free to adapt international standards, leaving the EU. Well, we've never been captured. So, for example, with Basel III, we have taken these really rather complicated rules for large exposures, for example, and most of them we've managed to adopt. But in some areas, we've deliberately not adopted them because, as you can imagine, banks here are much smaller than Basel imagines, and certain Basel rules are not appropriate. So I think what Philippa is talking about, we have had some experience of that here. And also, talking about international regulations, we will, and we are working with the states of Guernsey to establish a bank resolution committee in the future. Looking forward, there are several key challenges for banks. One of them is the continuous need to abide by financial crime regulations. I make this point every single time, and I can only reinforce what Fiona said earlier today. To take a phrase, it seems to me that FATF is ever deeper and ever wider. And I have some sympathy for banks who have to face that continuous call. It is a bit like having to paint the Forth Bridge over and over again. But if banks do not, at a group or local level, do this, there will be damage to that bank and to the jurisdiction. Another challenge for banks is to calibrate lending accurately. It's perhaps the most fundamental thing banks do. But according to official estimates, there's no getting away from the fact that in both the UK and in Guernsey, there was a significant contraction of the economy last year. Banks, therefore, have the difficult jobs of continuing to lend to prevent a further economic downward spiral, but at the same time, maintaining sound lending criteria. That's a pretty difficult tightrope to walk. Whether banks have succeeded in doing it, time will tell. Finally, in the context of banks, I'd like to refer to the case of a bank fined by the Jersey Financial Services Commission. And yes, we do occasionally talk to each other. This was in part because that bank had inadequate local compliance resources. And we do get this problem in Guernsey as well. I would therefore urge Guernsey bankers to keep speaking up for Guernsey when it comes to dividing out scarce group compliance resources. Your voices need to be heard at group level. Otherwise, Guernsey risks being left out. I know people are very articulate in that area. So turning to insurance, as Catherine said earlier, applications have been pretty strong, but we have seen a bit of a downturn in insurance last year. I don't think we should be too worried about this. If you're a UK bank, if you're a UK firm dealing with COVID, now may not be the best time to set up a captive, even though the economic arguments are very strong. And in the long term, I think that will work out. It's more difficult to forecast the future for ILS, MGAs, and longevity providers. In terms of policy, except for green insurance, which I'll mention later, the Commission has given both itself and the insurance industry a break last year. And this was in the wake of a series of policy changes initiated in front of the 29 IS inspection that we had. Now, there are still some additional policy changes that we have to make as a result of that inspection. But the main message of that report, which you can read on our website, is that we need to do more insurance supervision. And despite this public statement, it is interesting that insurance firms periodically lobby for lower fees. For those firms that are doing this, I'd ask you to think about two things. One, how does that fit in with the request for more insurance supervision? And two, lower fees for you mean higher fees for someone else, either within your sector or across the sectors. And incidentally, the insurance sector, I notice in particular, often asks the Commission to turn on a sixpence in response to the latest new idea. Again, the industry needs to remember that in starting work on one person's or one sector's initiative, we have to stop working on something else, given that resources are very limited. I have two key thoughts for the insurance sector. Last year, the Commission fined an insurer in part for inadequate control over outsourcing. And I noticed William and Gillian talked a lot about outsourcing, and I'm going to carry on doing that. But if an insurer chooses to outsource activities outside Guernsey, please make sure, I'm talking to the managers here, that it does so in a control environment. Too often, it is still out of sight, out of mind, and that is the wrong frame of mind, especially for a jurisdiction that, given its size, relies so much on overseas outsourcing. Secondly, and again this touches on the fine firm, those insurers who serve the retail public need to take a special care around compliance, control, and governance. There is a material difference in a captive insurer covering parental risk to an insurer providing insurance for the man in the street. And in our experience, not all insurance managers understand this and adopt the same approach for both. Finally, I'd like to talk about the local insurance intermediaries. And I refer firstly back to the beginning of the COVID period, that awful period of spring 2020. And at that time, there was a lot of uncertainty about travel and health insurance. The Commission developed a bank of FAQs to answer public questions, and we had people ringing us up as well. We could not have done that without the help of general insurance intermediaries in Guernsey. And as with the banks, local Guernsey intermediaries spent much time supporting the local community in a period of uncertainty. I think that was a huge success. For insurance intermediaries, I recognize, though, that probably the key issue at the moment is getting professional indemnity insurance, and the fact that the prices are going higher and higher by the day. And Gillian in particular talked about this. It's true with fiduciary as well. We're very well aware of this. So it would be easy for us at this point simply to lower our regulatory requirements response. Our sense is that perhaps this might not actually solve the problem, and it does raise the question of consumer protection, especially in a jurisdiction without a financial services protection fund. So we have been talking to many insurance intermediaries about this, and as Gillian said, this is something at the top of our agenda within the Commission, and we will be talking with Gillian's fiduciary side to see if we can come up with a combined approach in due course. So unlike the banks and insurers in Guernsey, there's no trade organization for insurance intermediaries. And whilst we're in touch with several intermediaries bilaterally, this means that it's important to hold an insurance meeting with intermediaries at least once a year. We haven't been able to do that because of COVID, but we're absolutely determined to do it again at the soonest possible opportunity. While, so to speak, on the consumer side, there is the Credit and Finance Policy Letter with the States, agreed earlier this year. Now, primarily, this means that credit provision will become a licensed activity in Guernsey. In particular, this brings non-bank lenders and brokers into the regulatory scope for the first time ever, apart from the NFRSB registration process. Now, the Commission engaged with lenders in 2016 and 2017 on this. Actually, I've just been going back in the files of this, and we were actually working on this in 2014. I'm not sure I'm going to beat CRISMA's 8-year record on this, but we'll see. The difference is that this is now really going to happen because the states have instructed the law officers to draw up the law, and they're busy doing that. That means that there will be regulations in place in due course. We're working with the law officers very closely on this. This new format of regulation will provide additional confidence for the Guernsey public in the local financial system. But it is a very significant change. And the more and more I talk to credit and lender in the field, the more and more I realize the extent, the depth, the scope of this potential reform. So it's going to occupy a lot of time in 2022. And a notable part of the credit and finance legislation will be the intention of the states to bring into the regulatory scope digital lenders and facilitators. And these include platforms facilitating crowdfunding and peer-to-peer lending, AML platforms, and virtual asset service providers. Again, this is a big issue. The benefits of this are to ensure that the bailiwick moves with the times in terms of customer protection. For example, the UK has long had crowdfunding rules, but also to ensure that there are no anti-financial crime gaps in our regulatory framework. There are two areas I'd just like to mention also that touch on all the areas: insurance, insurance intermediaries, and banking. The first is the continuing need for cybersecurity. Now, earlier this year, the Commission published cybersecurity rules. And a common global observation around cybersecurity is that boards tend to pigeonhole cybersecurity as an IT issue and then proceed to overestimate the efficacy of their mitigation. It is therefore important that Guernsey licensees take care to assess and mitigate effectively the cybersecurity threat, which of course gets ever bigger the more we work at home and the more appliances and devices we have. The second area I'd like to mention, and Gillian mentioned this, is climate change, not least as today is World Earth Day. There's an interesting article today in the FT where a journalist says, wouldn't it be an idea if Basel issued green capital rules? And I was thinking, hold on, because no one's done that. I said, well, actually, we've issued green capital rules already. It's on the statute book for insurance, for life insurance. I'm tempted to write to this journalist saying, excuse me, would you like to look at ours? And actually, that's quite important because I think Guernsey can act here. Small regimes can sometimes act as an incubator for something that bigger players are afraid to do. So we have on our statute, our rule book at the moment, capital rules for life insurers. And I think that's quite a competitive advantage. We're also, on the green side, very active in various international bodies to ensure that our point of view, of that of a small regulator, is being taken account of. And in fact, if I can tell you within my own world, within the Network for Greening Financial Services, we've managed to get Gillian's piece and also the spring paper on a website that sits next to the Banque de France, the Bank of England, all the rest of it, to explain that this isn't just an issue for G20 institutions. And we have, of course, issued our spring consultation paper. And apart from the fund side, the key point here is that it suggests that all boards of all licensees should consider how climate change affects their business and risk profile. Consultation period for that is still open, so I welcome comments on that. I realize that for banks and particularly captives, they cannot just state a view on this. It has to be done in the context of groups. But nevertheless, it is important that even at the subsidiary level, climate change is considered. It will certainly be an increasing part of the regulatory dialogue in the bailiwick now and going forward. So outside Guernsey, international regulatory attention in the banking and insurance fees has continued to focus on climate change issues despite COVID. And I'm absolutely sure that those of you following COP26 in Glasgow will be deluged with regulatory material on disclosure, scenarios, data cleansing, and even nature risk in front of that meeting. While speaking of international regulation, the last year has seen no travel, but we have at the Commission been in touch with a number of our peers, particularly through the Group of International Insurance Centre Supervisors, and that has been very helpful, largely in the process of hand-holding. And it's also enabled us to calibrate our own response to COVID when we talk to people like the Bermuda Monetary Authority or various others. So what's the future looking like? Well, it's mixed, in my view. I think for banks, the net interest rate margin will remain tight, and some lending may turn sour as official support eases. And insurers, whether general or captive, should benefit from a continuing hardening of the market. Intermediaries should see travel insurance pick up. Nevertheless, there is, in my opinion, and as William referred to it, a long-standing, increasingly real threat to financial stability in the form of inflated global asset prices. On the other hand, crystal balls have become curiously out of fashion in recent years. So, thank you for listening. In addition, thank you to all those cats and dogs, and in one case, hamster, who have made personal appearances, along with their human pets, on video calls that I've been on over the last year. But alas, I did not encounter a goose. Thank you very much.